Please stay tuned after the conclusion of the podcast for additional important information. Hello, everybody. Welcome to another edition of Accrued Interest, PIMCO's podcast dedicated to financial advisors and their clients. My name's Greg Hall. I lead the wealth management business here in the United States, and I'll be your host for today. It's mid-year. It's June 16th as we're recording this. It's a perfect time to check in with Dan Ivascyn, our group CIO. You'll all remember, I hope, that we had Dan on the podcast back in January to kick off the year. And we're going to try to maintain a pace here where we have him join us in January, join us again in June, July. We can do a beginning of year outlook and a mid-year check-in. I'll get into it a little bit with Dan as we talk through it. It's amazing to me how much has changed since the last time we spoke to him and how little has changed since the last time we spoke to him. And so there's a lot of detail and content to unpack there in the conversation. I'd love to encourage you while I've got you here at the top of the podcast. One, please do subscribe. It's a great way for us to know who's out there, who's listening to us, and make sure that we can tailor content that is appealing to you. Also encourage you to visit our website. If you identify yourself as a financial advisor, you'll be taken to Advisor Forum, which is our dedicated destination on the PIMCO website for you to access content and information that you as a financial advisor need to get it efficiently and make sure that you can spend as little time as possible getting exactly what you need from us and using that to fuel your conversations with your clients. So with that, I'm going to move along to a conversation with Dan, who's joining me in our studio today. Dan, thanks for making the time for us.
Thanks, Greg.
It's good to have you on the East Coast. You've been here for a little while now, meeting with the investment team, seeing some clients, and I think you let us know, the last time that we did this podcast. You Massachusetts guy and grew up on the East Coast. It must be nice to be back home for you.
It is. I've been here for a couple of weeks in New York. Got to get back to Cape Cod over the weekend.
Yeah, I
have the kids and the family there, so it's nice.
Is that where you did Father's Day up at the Cape?
I did.
How's that?
It was a good time.
Good.
Kids had fun. I got a card from my oldest daughter and some Tootsie Rolls, which were nice.
That's great.
But no, we had a nice time.
Yeah,
it's a good time. Good time of year up there.
I have teenagers. I mostly got eye rolls, but I did manage to get a hugger or two out of them. It's great to have you here. I was looking back actually on the last time we talked for the podcast because I really just wanted to take a little bit of a stroll down memory lane and revisit some of the things we talked about. And then think about where we've been. So you and I, sat in this room in late January of this year, and had a pretty broad-reaching conversation about markets, which we'll do again today. But let me just set the stage. I wouldn't say I was floored by this, but it is kind of interesting to me. So the 10-year, the last time we talked was at 453. I checked it about 5 minutes ago. It was about 445. The S&P, when we recorded last time, at 6,071. Today, 630, 640, or 6,030, 6,040, give or take. The 30-year, 478. The last time we spoke, it's backed up to maybe in the 490s today. The real change, which we can talk about, the dollar. Index down about 10% since the last time we spoke. But what really struck me, and the ag, let's mention the ag, the Bloomberg aggregate up about 2.7% for the year. And what really struck me about all that is putting the dollar aside, if you didn't know that April and Liberation Day had happened and you just sort of checked in with us at the last time we recorded this and today, the stability of those numbers. It's sort of an interesting thing, right?
It is, and it's felt like it's been quite volatile. It's felt like bonds haven't done so well, and again, I was looking at it, from the beginning of the year, and last week I think we literally hit the same yield that we started the year at. So a lot of movement. I think if we step back and look at movement across various global markets as well, you'd see a lot of localized volatility. But at the end of the day, if you just checked in every couple of months or so, you wouldn't think too much happened. So a lot of noise out there, of course, but pretty good yields and pretty good returns.
It's funny that you said noise, because again, I was going through the transcript and as we kicked off the conversation last time, we just published our cyclical forum at the beginning of the year, which is a research piece that we compose after the whole firm gets together and talks about, call it a 6 or a 12-month view, just to remind listeners what that is. And your view at the time, as you were speaking to us, was basically there's going to be a lot of noise, but starting yields are really attractive, and kind of base case is that bonds will generate their yield, and then you have some upside optionality if there's a drop in the overall rate environment and you capture some total return. And that to me is just sort of interesting, because that's of course what's happened in the intervening time. So maybe we should talk about the most recent forum piece. You just alluded to it because we had our secular forum, I guess back in May now, and published this past week. We called it the Fragmentation Era. What led to that title, and what's kind of the main hypothesis of the report?
Yeah, look, my sense is that it's just another reminder that we've taken a few steps back from these multi-year globalization themes and trends. We've talked about it now for a couple of years. We talked about it at the start of this year. We're in a really interesting investment paradigm, one that's a little bit challenging for those that grew up learning economics, financial theory, discounted cash flow analysis. This came up, was at an event in London recently where one of our advisory board members framed it well, I think, that through much of our careers, economics or financial market outcomes tended to drive politics. And what we mean by that is that when economies are strong and when financial market pricing is positive, or when financial markets are doing well, it tends to lead to good outcomes for those politicians in charge. Today's world's different. Today we have a variety of geopolitical themes, political priorities that are driving economic outcomes. I think tariffs are probably the best example of that, but there's certainly other themes or cross currents at work as well. This is leading to less synchronized markets. You saw it earlier in the year with Germany. The very uninteresting German market, and I say that respectfully. Typically people are willing to give yield by moving into a predictable market,
right,
governed by strong fiscal prudence, and in return they get a relatively low volatility type environment. But they have to give up a little bit in yield. And of course, we were surprised, this year by Germany pivoting quite significantly towards a mindset of spending more money on defense to strengthen their own economy. And just one small example of how we're in an unpredictable world, a world with more frictions than we've grown accustomed to. And it poses some risks for sure, but it also creates great opportunity for investors to take a global opportunity set into consideration, to delve into markets they may have understandably forgotten for many, many years. And it's an environment that's fun again, exciting from the standpoint of generating a little bit of additional alpha on top of the attractive yields that you mentioned at the start of our conversation today. So that's really the key theme, is that what may appear irrational from a financial markets perspective can be quite rational when you take some of these longer term political considerations to heart. And of course, that involves a lot more input from policy experts, monetary policy, people that understand the priorities of various administrations around the globe. And we're fortunate to have a lot of those folks around PIMCO, and they have gotten even more involved in our investment process more recently.
I feel like I recall this conversation maybe creeping up into some earlier forum discussions, maybe going back to Trump 1.0, when the president sort of initially was signaling some of his reservations about NATO, and that maybe your recollection may be different, but what I remember is that sort of prompting us to think about a world that was less synchronized, where economies would seek to maybe protect themselves or consciously, to borrow a popular phrase, to consciously decouple a little bit. And so I would imagine that, from your standpoint and how you've chosen to sort of surround yourself with advisors here at the firm, surprising certainly, but not out of the clear blue sky, right? This is something that we've been expecting to some degree for a little while.
Yeah, I think that's right, and we certainly got a flavor of Trump's priorities during his first term. We also got a flavor of the style and how Trump approaches various issues, including negotiations. With that said, I think it's safe to say that the markets and us to a degree were surprised by some of the administration's approaches thus far.
Yeah.
Liberation Day tariffs, of course, being higher and using a calculation that surprised the markets. Even some of the foreign policy initiatives around Greenland, Canada, just the style. And I think that's important in an environment like this one, is to try not to get whipped around by the noise. Try to understand that we're in a different paradigm. Try to use every tool in the toolkit so you don't need to take highly concentrated bets, but just appreciate the fact it's going to be different. And you need to take a creative approach to analysis here. And I think if you do so, as I mentioned earlier, this is an incredibly target-rich environment. It was back during the first administration, but now we have a real value advantage. Higher yields as a starting point, and that's quite exciting to have the ballast and the predictability of very, very high cash flow, at least in a fixed income context, and then be able to generate return for clients relative to passive alternatives in a volatile and rapidly changing environment.
How do you? We want to get to specific investment outlook and talk about markets, but how do you help the team, and how do you personally sort of check cognitive bias and avoid letting some of the chaos? Again, I don't mean that disrespectfully, but the just the volatility, for lack of a better word, around so many different poles from whipping us around, causing us to overreact.
I think the first step is just realize, there's going to be emotion that gets in the way of good objective decision making. This is an environment where people have different political perspectives, and where style can get people riled up on both extremes of the political spectrum. I'd like to think, at PIMCO for many, many years, we've put structures in place to help us make, good, sound, objective decisions. Bill Gross was a very strong personality, very, very well known in terms of views, but he really, really left us with a lot of investment structure. You mentioned our forums, where to avoid the noise, we get everyone together with outside, real solid contrarian thinkers once a quarter. That was important, almost 27, 28 years ago when I joined the firm. I think it's especially important today, where you have X and Instagram and other
almost There's a lot more noise,
constant noise to avoid. So again, easier said than done, but I think good structure matters. And then, I've said this before, I've always been a big fan of the behavioral finance literature. I think all of us have read it to some degree, fall victim to some of these themes, overconfidence.
Sure.
I think you know us well on the portfolio management side. We're certainly a group that's prone to overconfidence. I think the longer you do this and are reasonably successful, the more you can succumb to these types of temptations, things like confirmation bias, seeking out information to support a view you already have. I can't tell you how many times I'll get sent an article. It's typically quite consistent with a person's investment views and political views as well. And I think again, I fall victim to that from time to time. We have a great consultant in this area that has embedded herself as Anastasia Boyakaya. And others into analyzing the way we make decisions and constantly looking to enhance our process. So I think in this type of environment, it's more important than ever. And being able to make good, solid, objective decisions when other areas of the financial markets are not is an important source of alpha over time.
Let's get in a little bit in terms of macro. So we spent a lot of time the last time we spoke, sort of talking about your outlook for the U.S. economy, for rates and inflation. I think one of the things that since we last spoke has maybe come to the fore in terms of advisor interest and advisor questions is fiscal sustainability in the U.S. Right? Will the U.S. ultimately be able to finance itself? What will bond vigilantes maybe do in the long end of the curve over time? And how does this really influence kind of the core, small c core appeal of fixed income in a portfolio? So is it okay? Can we start there and then move into other areas?
Sure. So a couple of points there. The first is we spent a lot of time looking at the U.S. fiscal situation in an absolute sense, forecasting what it may look like over the next several years, and then more importantly, putting it in a historical context. And when we do that, there's some not so good news, and then some decent news there. The first point is that although over the last couple of months, especially with the focus on Doge and Elon Musk's very direct views regarding concerns around debt and deficits, it's been discussed a bit more than it had been discussed. But it's still not an important enough issue from a political perspective where we believe we'll see a meaningful improvement in deficits over the course of the next few years. So, when we look forward, and we do think that this big, beautiful bill will get passed. It may not get passed before the 4th of July holiday, but it will likely get passed at some point before the end of the summer.
More or less its current form, or rhymes with its current form?
Probably pretty close to the current form. And actually, to get it through the Senate, it may lead to slightly higher deficit spending, in fact. And again, what we see going forward are deficits in the 5-6% type range, give or take. And those are high. They're especially high at a time where the economy continues to expand. So that's the concerning point. When you step back and look, though, throughout history, and you take into account the significant advantages the United States has in terms of still being the global reserve currency, and we said this in our secular outlook. We're not losing that soon.
Yeah.
I think it's fair to state that pretty definitively over the course of the next few years.
Currency can weaken, but we're not. I don't want to say we're not concerned, but it is not in your sort of realm of normal distribution that we should be worried about the U.S. dollar being supplanted by something else.
Yeah, and I think that's the important second point, though, is you could retain your global reserve currency status and still have your financial assets and currency underperform other parts of the world. And we will talk about this later, I'm guessing. But I think the key point is when you look at the U.S. fiscal position today relative to other developed market economies throughout history, even our own situation back in the 80s, it does appear that the situation will be manageable. Manageable defined as, the markets in the yield curve will likely be more volatile than it's been in the past. We've been a big proponent in suggesting that the yield curve will steepen. We've had that position on across portfolios. It's been quite profitable for us, and it's not just based on concerns around fiscal sustainability, but that is one reason why we do think curves will be steeper than they would be otherwise. But we do think when you look at the U.S., you compare our country to other countries coming out of the First and Second World War. When you look at debt service requirements today versus where they were back in the 80s, it does appear that we have time on our hands. Now, again, when I say this, it always feels like I'm coming across too complacent. I think that's a very, very important point, is that we're not complacent here. There are other alternatives to just owning a lot of very, very long maturity debt issued here in this country. You can diversify into other parts of the world that have a better fiscal picture, the same yields, even in some cases higher yields in U.S. dollar terms, and a less vibrant economy. That tends to be a pretty good combination for
fixed income investors.
Fixed income returns. So, we've been doing a lot of that. And then, again, not solely based on concerns around debt sustainability, we have been owning more intermediate maturities and not venturing out in the long end as much as we would otherwise. One point I like to make, though, it's really, really hard in a narrow sense to time a bet against fiscal sustainability. I only have to go back a few years to 2023. If you remember the late summer of 23, we had the Fitch downgrade.
Yeah.
Lots of concerns around deficits back then. A lot of concern about inflation back then. This was a time where the inflation numbers were much worse than they are today. And people were very, very focused on the Fed having to take rates materially higher, perhaps up, north of 5%. So that was a point in time where it turned out to be a great time to buy the long end of the yield curve. I think from the first week of October 23 into year end, the 30-year yield dropped by over 1 percentage point.
Yeah.
We've seen it in Japan as well for many years, betting against fiscal sustainability there. So, it's an area of focus. It's an area of concern. If we do not get deficits down, investors, including PIMCO, will look for other alternatives, look to diversify away from U.S. assets. But we don't think it's a crisis just yet. In fact, one of the reasons why we're able to earn a very attractive yield lending to the U.S. government as a private market participant is because of higher deficits. So in some sense, it's not all bad. The higher these deficits go, the longer they remain, the higher the government's going to have to offer us in terms of yield in order to lend to them. So again, a complex situation. We are, diversifying like many other investors, but we think that some of the concerns in terms of a crisis around the corner are, a bit overstated.
I think the last time we spoke, you made the point, happy to lend to the U.S. government kind of with a 3 to 5 year time horizon, maybe a little bit less excited, 20 to 30 years. Is that a good kind of barometer for your feelings on duration right now?
It is. We like duration here, and we like duration because yields are high.
Yeah.
Nominal yields are high, even when you subtract today's inflation rate, you're still left with a pretty attractive return. And then, across most markets we operate, we prefer that intermediate part of the curve. Some of it's tied to the fiscal situation. A lot of it's just, tied to the fact that we see better value there, a bit more clarity in terms of what's likely to occur over the next few years versus 30 years. And then a more complicated argument or complex argument is that that's the part of the maturity sweet spot where if we were to have a hard landing scenario, if we were to have a recession, at some point over the course of the next year or two, we believe that's the part of the curve that will likely outperform.
I'm glad. Yeah, I wanted to ask you about economic fundamentals. Then, has anything, kind of post Liberation Day, given maybe we know a little bit more about any stimulative qualities of the tax bill, what do you think sort of, maybe over the cyclical horizon as it relates to the economy, recession fears, likelihood of, more aggressive Fed action or the need for that?
Yeah, so there's a lot of uncertainty, and maybe I want to be clear here. We have some great economists.
Mm-hmm.
We have Rich Clarida, recent vice chair of the Federal Reserve, Tiffany Wilding, Alison Boxer. I could go on and on that are really good at forecasting.
All podcast guests, and we have to have Ali on, but
okay.
But Rich and Tiffany have been on recently. Yeah,
and what we say to both Rich and Tiffany is that we want your forecast for growth and inflation and other key economic data without overlaying a view as to how the Trump administration may ultimately be negotiating tariffs, whether they're going to step back or not from the very, very high tariffs that they have initially put in place. We have Libby Cantrill, we have other advisory board members to do that type of analysis. So we want just pure economic forecasts based on the assumption that what's currently in place will remain in place. And under that framework, we've had a massive shift in our thinking around recessionary probabilities, what inflation may do over the course of the next few quarters. I think at one point in time, we're up around 60-65%.
Yeah.
Today we're
probability of
recession over the next 12 months. Today we're somewhere around a 35% probability. So above the typical 20% probability, even if you have no view on the economy. But I bring that up only because it's another example of just how uncertain this economic environment is, because the policy environment is quite uncertain on the inflation. So basically, where we are today, we think the U.S. economy probably grows in the low to mid 1% range for 2025. We see inflation hovering somewhere in the 3% range, give or take, primarily higher because of the tariff policy that we believe will remain in place. Somewhere, an effective tariff rate somewhere in the low teens, as an example. And again, our recessionary probabilities are somewhere in that 35% range. So since Liberation Day, we have become more constructive on the near-term forecast for the economy, primarily because the tariffs have been ratcheted back.
Right.
And then the point on the big beautiful bill, or the fiscal package. A lot of this is an extension of tax cuts that were already in place, but there's going to be some new measures that are stimulative. And the structure of this bill is such where a lot of the stimulus is going to be more front-end loaded, with the revenue offsets coming at some point, 2 or 3 years down the road. So on the margin, if we get through this period of more extreme tariff uncertainty, if they remain somewhere close to where they are now, which is a big if, we still think that there are going to be more sector-level tariffs coming. We'll have to wait and see on the China situation, which is far from resolved.
Right. And
there'll likely be some more targeted tariffs introduced across countries that received the benefit of this grace period. But our general sense is this will be a market where we continue to see some negative impact from tariffs over the course of the next few quarters. The positive fiscal, and I say positive in a narrow sense, the stimulus will likely kick in early next year. And the net result will be slower growth here. Inflationary pressures lingering higher for longer, but the base case is slow growth, not a recession.
What do you think that means then for credit? The last time we spoke, that was an area I think you were concerned about and prepared to be more concerned about, just kind of given recessionary views. Now that we've rolled back from a 65% probability to a 35% probability, how are you thinking about the corporate sector, the consumer sector?
Sure. Well, let me step back for a minute. This has been a very, very unique environment for credit in general. And it's really been unique since coming out of the global financial crisis back in the 2008-2009 period. That was the last example of sustained volatility in markets. Now, you may say, well, wait a minute, we had a global pandemic just a few years ago.
Keyword was sustained, right?
Sustained. Yeah. I was going to say that sustained is the key point. Yes, we had the biggest shock to lifestyles in economic growth in our lifetimes.
Yeah.
But we also had the largest fiscal and monetary response as well. So this was a period where you should have, in theory, had a cleansing period across markets, getting some of the weaker corporate entities, out of the market. That's typically what happens when you have a negative growth shock of that degree. But it didn't happen. So when you step back and you look at the most economically sensitive areas of the credit markets, the leveraged lending space more broadly, it's been incredibly one way since the GFC. Strong performance for those that went down in credit quality, right. Typically picking the highest yield, the lowest rated, most economically sensitive areas of the market, and you would have done the best.
Yeah.
In this uncertain world we live in today with elevated recessionary risk, we just see much better value in other areas of the market. We think investors could take advantage of higher quality sectors of the market that have better fundamentals, even better technicals up to some degree, take advantage of a global opportunity set, and end up in a much better place. Similar yields, but a much more resilient profile if we were to have a harder landing type scenario. And I always remind folks that if you never have a recession, you don't know what's resilient versus what's not resilient. I remember going all the way back to the mid-2000s when U.S. home prices just kept going higher and higher and higher. It took a long time to figure out that this lending was getting excessive, that there weren't enough quality borrowers deserving of credit extension back then. Yeah. We know that ended poorly. So, I don't want to, sound overly inflammatory here, but, we do think the combination of tight spreads, deteriorating fundamentals, weaker covenants, have created more risk than reward in certain segments of the leveraged lending market, mostly the floating rate areas of the market.
Yeah.
I also say that regulators hate bailing out the same sectors twice. And going back to the GFC, it was consumer lending, it was mortgage lending that caused all the problems. The banks caused a lot of trouble, and as we know, those sectors have been massively overregulated coming out of the global financial crisis. So we really, really enjoy today and think it makes a lot of sense lending to the consumer, the U.S., Europe, even other parts of the world. You've had a significantly improving household balance sheet over the last 10 to 15 years, while government balance sheets have put on more in more leverage. Similar dynamic in the corporate markets. Investment grade companies in pretty good shape. Companies that issued in the high yield market in better shape. A lot of the excess this time is migrated into the more risky areas of the non-financial corporate credit markets.
Yeah.
So again, not surprisingly, in our public strategies and our private strategies, big overweights to asset-backed and asset-based lending, looking for other high-quality proxies that offer attractive yields, agency mortgages, senior structured products, a lot of times, with a true AAA, AA, single A type, solid investment grade rating, defined as a PIMCO rating after doing our own internal credit work. There's a bit too much of a reliance on external ratings at the moment. Echoes back to the mid-90s and the mid-2000s when rating agencies were very, very involved in driving various forms of financial engineering, and where the market, not surprisingly, after many, many years of strong credit performance, are beginning to suggest that a rating agency investment grade rating is as good as the bottoms up work you can do with more sizable teams in markets. So those are some of the high level thoughts in an area where we have tremendous conviction at the moment.
Yeah, you're not trying to be inflammatory, and you're not being inflammatory. There are, from your description, there's a lot of things that do sort of rhyme with the pre-financial crisis complacency. It's always nice to be told what you want to be true. And so when somebody, if it's a rating agency or anybody, tells you something's worth par when you're concerned it's not, I would imagine that feels good for a lot of investors out there. And for a while now, there's been no consequence to maybe not thinking about that more deeply and really interrogating your position. What I would say, it's been interesting to me just over the last couple of months, Dan, in being out there talking to advisors and going to a few conferences. We'll say, I think the typical advisor we speak to is getting a little fatigued with some of these. It's funny, you refer to them as lower quality areas of credit because the borrowers are in fact smaller and more leveraged, and they're not always those forms of lending aren't always pitched that way, I think, to financial advisors, being referred to as lower quality. But there's been, for the first time that I can remember in the last few years, some real fatigue developing around that storyline and a real desire to diversify into other areas of be it public or private credit, which feels very healthy, right? As advisors have a bigger menu of things to do. We had Chris Kraus on the podcast for the last episode talking about asset-based lending, talking about real estate lending, and different areas that we're exploring right now that are less crowded, less competitive, maybe still offer some excess return relative to a unit of risk or liquidity.
Yeah, I think that's right. And again, it's been a remarkable run for strategies or sectors that represent loans to lower quality, more economically sensitive corporate borrowers.
Yeah.
A lot of these are smaller companies that have historically underperformed their larger cap counterparts during periods of economic stress. And then you had the 2022 experience where public stocks went down quite a bit,
Yeah.
and owning some bonds didn't help.
Yep.
And you had an even more powerful sell-off in longer maturity, high-quality bonds. So not only has the absolute performance in the more economically sensitive areas done well, but the relative performance was quite striking back then.
Mm-hmm.
And it benefited not having to get marked to market. So there's probably even a touch of complacency in certain pockets of the market in that regard as well. But when we look forward today and you look at opportunities to generate attractive yields, both in the public and the private segments of the market, and be able to obtain significant resiliency for clients. It's an incredible asset allocation opportunity or relative value opportunity. In fact, and I rarely make these bold statements, but it's one of the most obvious and attractive relative value opportunities I've seen in my entire career. And again, you won't know it until the economic shock happens. And then the one area that we didn't talk about today is tech innovation.
Right.
I know a lot of focus on U.S. deficits, U.S. debt levels, but we have an incredibly dynamic economy. We have an incredibly strong tech sector, and we have what very well could be a multi-year period of significant change tied to artificial intelligence and technological innovation. That can be very positive for the economy as a whole. It can be very positive for stock markets as a whole. But the more productive this technology becomes, the more disruptive it can be to old economy leverage lending models. And I think that's something that may rear its ugly head in a very, very subtle but potent fashion.
I heard you make this point the other day, and I hadn't heard you say it before, and it just struck me as so abundantly true at the time. So much of deal activity over the last 5 years has been in the software sector, and you'd look to that sector and say, where are we as likely as anywhere else to see disruption from AI, from other forms of new technology displacing existing technology? And it's interesting because we say old economy, but very recent economy could be disrupted by AI.
Absolutely right, and I think when you step back and you look at markets today, you look at how competitive certain areas are from an underwriting perspective. A global environment of significant macro uncertainty, geopolitical uncertainty, where tariffs are going up and where there's the risk of trade wars or tit-for-tat increases in tariffs, combined with massive disruption from a technological perspective and higher for longer rate scenarios, this would be an environment where you'd say, hey, look, let's give up liquidity for 5 or 10 years and lend to companies in a highly levered manner, or put more debt on old economy companies. So again, the macro picture has changed a lot the last few years as spreads have tightened, as protective covenants have deteriorated. Again, now I am sounding a little bit more alarmist. That's not meant to be. That's not my goal here. It's just again, the fact that you do not need to subject yourself to this type of uncertainty. There are great opportunities in asset-backed or asset-based lending. There are pockets of the market that haven't grown as significantly, where you can issue to a company on a fixed rate basis, where they're not as susceptible to these higher for longer type front-end rate scenarios. So it hasn't mattered up until this point. It very well will matter over the course of the next few years. And again, we're still talking about an environment today where you can generate returns within a broad fixed income opportunity set, depending on how much complexity you want to take on. So it's an exciting time, but we do believe that this is an environment where you want to be more selective. You want to be a little bit skeptical of markets that may have grown too quickly. And the great news is there are very, very logical solutions or alternatives.
Let me ask you. I'm curious. You mentioned giving up liquidity. And I've been thinking about this a lot. People talk about the liquidity premium, and you often hear it described almost in static terms, like the liquidity premium should be 200 basis points. And I wanted to ask you, do you think of it as a fixed item, or given the volatility and the kind of spread of outcomes that you see available in this environment that's more fragmented than maybe where we were 5-6 years ago, like what is the value of liquidity to you, and how do you think about that even mathematically when you're making decisions, public versus private, in portfolios?
Yeah, so we will make the decision based on the particular mandate that we're running on behalf of clients. Yeah. We run daily liquidity vehicles. We run permanent capital vehicles, where all of the liquidity that our clients obtain, and it can be quite good liquidity, are through an exchange. Mm-hmm. And then we have everything in between. So what we try to do is we try to look at what the particular goals of our clients are in a respective strategy, and then look at the cost for going down the liquidity spectrum. Now, it's never or rarely is it binary nature, super liquid, super illiquid. There's a whole continuum of different liquidity profiles, and we look to adjust to where you are on the liquidity spectrum to make these decisions. One comment, and this is an area where we're really excited to talk to clients in more detail, is that rarely are there apples to apples comparisons being made on liquidity pickup. I mentioned this earlier. Today in certain quarters, there's this assumption that if you could find an investment grade rating on something, then it should be compared to some type of generic form of investment grade risk elsewhere.
Right.
We know that's not true. You don't need to move into the deeply illiquid space to pick up spreads in certain types of investment grade risk. A triple B CLO tranche is probably the best example.
Yeah.
It always trades wide to a triple B industrial. It always trades quite wide relative to a triple B industrial, partially due to liquidity, partially due to complexity, but the bulk of the spread is because people in the market know it's a riskier underlying cash flow.
Right.
Just one simple example. So, I think a lot depends on the mandate, but when we look at, the pickup for going from something very, very liquid to something quite illiquid today, typically when you make a true apples to apples comparison, that pickup's on the order of 30 basis points.
Wow.
Sometimes a bit more than that, maybe as much as 50 basis points.
Right.
In certain cases where there's more complexity, at times you're not picking up anything at all. And when you adjust for risk, sometimes, in this crazy world we live in today with so much growth in certain private asset classes, you're actually giving spread.
Right.
And again,
so you're upside down.
So you're upside down.
Wow.
So all these are areas where it requires, an ongoing discussion. But I think the bottom line is, as my old colleague Scott Simon used to tell me, don't make it more complicated than it needs to be. Maintain liquidity. Liquidity can come in handy when you least expect it, and get paid for going down the liquidity spectrum. I think what comes to mind, and I think listeners to the podcast can relate here, is just what's going on in the endowment community. The ultimate long-term model.
Yes.
Endowments tend to be perpetual in nature with a very, very long horizon. Just a year or two ago, people would have thought, wow, endowments are in a great liquidity perspective, and in fact have the ability to go down the liquidity spectrum far more significantly. An example of the uncertainty in the policy environment today, so many endowments at the moment are of the mindset that they don't have nearly enough liquidity. So things can change. And unfortunately, liquidity needs tend to be correlated to economic weakness. So when you have a recession, people tend to need to tap into their 401k, tend to need to tap into their savings when unemployment rates are elevated, when there's pressure on wages. So again, we've had a pretty good economic environment for a long time. This is an area where, again, certain investors will be able to give up liquidity. Certain mandates at PIMCO give us the flexibility to take advantage of great opportunities within the less liquid segments of the market. But it requires nuance. It requires, analysis, and it's, not nearly as simple as saying, well, there's, you could find a rating agency to give me a investment grade rating. Therefore, by that, if it's pick X to, something that's much more robust from a credit perspective.
Yeah, no, it's a great reminder that just because you can take on liquidity doesn't mean that you should. And I think, because we've been in this sort of consequence-free environment for a lot of different forms of risk, it's a good prompt, I think, for a lot of the advisors listening to kind of just re-examine their assumptions about what that illiquidity really gets them. Like if you're seeing 30 basis point or 50 basis point pickups, not as a rule, but as a common, I don't think that's the kind of premium that people are looking to pick up in those strategies. And so it's a good reminder.
Yeah, probably not. Again, having done this for 30 years, just be careful of, stories suggesting that, we have, we're in a new age and, some new, creative way to generate incremental return. Just be skeptical. With that said, there are great opportunities within the public space. There are areas to avoid. There are great opportunities in the private markets. And, again, public-private, that's going to be how things are framed. It really is a liquidity continuum.
Mm-hmm.
And you just, again, need to do good old-fashioned solid credit work, acknowledging the fact that we're in a highly uncertain policy environment. If you do that, you're going to be able to pick up resilience for a client. We, again, hope that we don't need it. But again, hope's not an investment strategy, and we live in an uncertain world. And regardless of what we may expect in the near term, we want to protect downside for our end clients and do so, with an attractive competitive yield versus passive alternatives. And as I said, it's one of the more exciting environments to do that. But be careful and look to differentiate along the way through conservative underwriting.
Look, one of the pieces of good news, I think, is, and we just had a big meeting of our sales team. Everybody dialed in. We have about 200 people on the phone. And I think one of the themes of that conversation is many of us have never seen an environment where advisors are so interested in different forms of diversification, whether it's non-U.S. for U.S. investors, more globally for globally situated investors, maybe re-examining alternative investments and coming back to more traditional investments or vice versa. But there's a lot to do out there. There's a lot, I think, to talk to us about. We've got a lot of viewpoints. We'll link in the show notes to a lot of the material that we've referenced today. I think, Dan, just in closing, again, the last time we spoke, I think your overarching view was there's a lot of risk in the world. There's a lot of unknowns. There's only so much that we can try to predict and build models and frameworks around. And then you've just got to be able to react to what comes at you in a very structured and thoughtful way. But that starting yields and just the basic fundamentals of fixed income right now, really attractive, able to absorb and help you remain resilient through those risks. From listening to you today, it doesn't sound like that viewpoint has really changed. You've added new data, you've added new inputs and new information, but it sounds to me like your basic outlook on the fixed income category is pretty consistent with where we started the year.
That's right. A bit more favorable, towards, non-dollar denominated risk. So you had mentioned earlier that, the dollar has been weak this year.
Yeah.
We, across most strategies, have had a dollar underweight. We think from that perspective, an even more exciting global opportunity set. But again, maybe finishing where we started, in our discussion earlier in the year, in the higher quality fixed income opportunity set, it's just not that complicated. You typically earn your yield if you have a 3 to 5 year type time horizon. We go back and look at the last 12 months and you basically earn your yield. And then in the context of an active strategy, try to pick up some additional returns through some thoughtful shifts in asset allocation, taking advantage of inefficiencies in markets and overshooting and relative value opportunities. So, quite target rich and, again, a great environment to provide incremental return versus passive alternatives. So it's exciting, although it doesn't feel that way every day when you get whipped around by the news. But be patient. I tell myself that every day, tell the team that every day, and just earn your coupon and then, benefit from some local volatility and the ability to earn a little bit, on top of that as well.
All right, Dan, thank you so much. That was a perfect way to sum up a pretty broad-ranging discussion. If there's anything else that those of you listening wanted to dig in on, let me encourage you one more time. Visit our website. If you identify yourself as a financial advisor, you'll be taken straight to Advisor Forum. That's our spot for you to access information, content that you need to fuel your client conversations. We will link in the show notes to a few of the individual pieces that were discussed, as well as maybe some of the outside research or outside authors that we referenced. If any of the topics that we discussed today are of interest to you, please feel free to contact your PIMCO representative and ask us as much as you like. We're here to help.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures